In trading, consistency isn't broken by the market, it's broken by emotion. Every chart, every candle, every tick becomes a mirror of the trader's inner world. The charts don't move against them, their emotions do. Emotional overload is the invisible storm that hijacks decision-making, distorts logic, and destroys the psychological stability required to remain consistent. It's not about being emotional in the human sense, it's about being emotionally reactive in a system that punishes reaction and rewards patience. When a trader starts, they often believe the challenge lies in understanding the market. They study patterns, technical indicators, and strategies. They build knowledge. But knowledge doesn't equal control. The market is a battlefield of uncertainty, and uncertainty triggers the deepest human emotions: fear, greed, doubt, excitement, and despair. These emotions flood the nervous system and override rational thought, leading to impulsive trades, early exits, over-leverage, or hesitation at the worst possible time. Emotional overload is not random. It's a predictable psychological cycle that repeats itself in every undisciplined trader. At the core of this overload is the fight or flight response, a biological survival mechanism that doesn't belong in the trading arena. When money is on the line, the brain doesn't distinguish between physical threat and financial risk. The same neural pathways activate. Cortisol rises, adrenaline spikes, and the prefrontal cortex, the part of the brain responsible for rational decision-making, shuts down. The trader enters survival mode. In this state, the goal isn't to follow the plan, it's to escape discomfort. Every market move feels personal. Every loss feels like a wound. Every win creates a high that reinforces destructive behavior. The emotional high of a winning trade is intoxicating. It triggers dopamine, the same chemical responsible for addiction. The trader feels invincible. They start believing they see the market, that intuition has replaced discipline. But dopamine doesn't just reward success, it reinforces the anticipation of success. The brain becomes addicted to the feeling of trading, not the process of trading. That's why traders overtrade even when they know they shouldn't. They're chasing a neurochemical reward, not a financial one. The flip side is fear, the trader's oldest enemy. Fear shows up as hesitation, self-doubt, and premature exits. It's the emotion that whispers, "You're about to lose," even when the setup is perfect. Fear magnifies uncertainty, and uncertainty magnifies fear. When a trader acts out of fear, they try to avoid pain rather than pursue a plan. They move stops, close trades too soon, or avoid taking trades altogether. Fear creates inconsistency because it shifts focus from execution to protection. The trader stops thinking about probabilities and starts thinking about safety. Greed operates in a similar psychological loop but hides under the illusion of ambition. The trader doesn't want more profit. They want to validate their worth. Each winning trade becomes proof that they're smart, capable, or superior. This creates emotional attachment to outcome, and attachment always leads to pain. When the market doesn't validate them, they don't lose money, they lose identity. That's when revenge trading begins. It's not about recovering the loss, it's about recovering ego. The mind refuses to accept defeat, and the trader pushes harder, forcing trades that don't align with logic. The result is predictable: more losses, more frustration, more emotional damage. This emotional cycle creates what psychologists call performance inconsistency. The trader's actions are no longer guided by method but by mood. When they feel confident, they follow rules. When they feel uncertain, they abandon them. Their equity curve reflects their emotional curve. Consistency in the market becomes impossible because consistency in state doesn't exist. They become prisoners of their own nervous system, oscillating between euphoria and panic, confidence and doubt. The danger of emotional overload isn't just in losing money, it's in conditioning the brain to repeat self-destructive behavior. Every emotional reaction strengthens neural pathways that reinforce the same behavior in the future. A trader who panics during drawdowns trains their brain to associate losses with chaos. Next time a trade moves against them, the brain automatically triggers anxiety, even before the loss becomes significant. Over time, this conditioning makes trading psychologically exhausting. The mind starts anticipating pain, and anticipation itself becomes the source of suffering. The irony is that many traders believe they can control emotion through willpower. But emotion isn't a switch you turn off, it's a signal you learn to manage. The problem isn't emotion itself, it's identification with emotion. When a trader believes the emotion is truth, they act on it. For instance, the feeling of fear doesn't mean danger is real, it means the brain perceives it as real. The most skilled traders develop emotional awareness, the ability to observe emotion without reacting. They build what psychologists call meta-awareness, consciousness of one's mental state in real time. This awareness doesn't suppress emotion, it repositions the trader as an observer rather than a participant in their internal chaos. Emotional overload also thrives in a lack of preparation. When a trader doesn't have a clearly defined process, uncertainty becomes amplified. Without structure, every trade feels like a test. The absence of predefined rules leaves room for improvisation, and improvisation invites emotional interference. Preparation acts as a psychological anchor. When the mind knows what to expect, emotion loses leverage, but when the trader enters the market with vague intentions, the mind becomes hyperactive, constantly scanning for threats and opportunities that aren't even relevant. This mental noise leads to decision fatigue, where even simple choices feel overwhelming. Sleep deprivation, caffeine abuse, and screen obsession worsen this condition. Trading for hours without mental recovery floods the body with stress hormones. The nervous system stays in a perpetual state of alertness, making emotional regulation almost impossible. The trader becomes hypersensitive to every tick. Their perception narrows. They start micromanaging trades, analyzing meaningless noise, and second-guessing every move. Emotional overload isn't just a mental problem, it's a physiological one. The body keeps score, and an unregulated body produces an unregulated mind. Another layer of emotional overload is social comparison. Traders constantly measure themselves against others, influencers, analysts, or peers who post screenshots of massive wins. This creates subconscious pressure to catch up. Instead of trading their system, they start trading their ego. They over-leverage, force setups, or increase size prematurely. The mind associates progress with validation, not mastery. Every missed opportunity feels like failure. Every winning trader on social media becomes a trigger for insecurity. The constant comparison activates the same emotional circuitry as loss, envy, inadequacy, and fear of missing out. This emotional turbulence creates a self-fulfilling prophecy. The trader feels anxious, so they trade poorly. Poor performance reinforces anxiety. Anxiety leads to overtrading, and overtrading deepens losses. The trader then seeks relief, sometimes by taking a break, sometimes by gambling with bigger size to feel alive again. Both reactions come from the same emotional source, the desire to escape discomfort. But trading mastery is about learning to stay inside discomfort without reacting to it. The market doesn't reward emotional avoidance, it rewards emotional endurance. Emotional overload also destroys the ability to learn. The human brain learns best in calm states. When emotion is high, cognitive performance drops, memory, pattern recognition, and decision-making become impaired. A trader under stress might make the same mistake multiple times without realizing it, because emotion blocks reflection. They remember how it felt, not what actually happened. Learning stops being analytical and becomes emotional. I hate this market. I can't win. I knew this would happen. Each of these thoughts reinforces helplessness. Over time, the trader internalizes failure as identity rather than feedback. Another psychological aspect of emotional overload is projection. Traders often blame the market, brokers, or news events for their mistakes. This externalization protects the ego but prevents growth. The market becomes a scapegoat for internal chaos. But in reality, the market is neutral. It doesn't attack or favor anyone. It reflects probability and liquidity, not emotion. The moment the trader accepts this, responsibility shifts inward. The emotional storm loses power because it no longer has an external enemy to fight. The root of emotional overload often lies in personal history. Traders bring their past into the charts: unresolved fears, validation needs, and self-worth issues. A trader who grew up associating failure with shame will unconsciously avoid losses even when they're part of the process. They'll sabotage trades to avoid emotional pain, not financial risk. The market becomes a psychological mirror, reflecting unresolved conflicts from the past. That's why two traders can use the same strategy but get completely different results. It's not about skill, it's about psychology. In trading psychology, this is known as emotional transference, projecting internal emotional patterns onto external situations. The market becomes a stage for the subconscious to play out its scripts. One trader might seek control because they fear chaos. Another might chase excitement because they fear boredom. Another might freeze under pressure because they associate risk with danger. Each behavior is an echo of an emotional memory disguised as a trading decision. To fix inconsistency, these emotional imprints must be brought to awareness and reframed. The cure for emotional overload is not emotional suppression but emotional integration. A trader must learn to feel without reacting, to observe without judgment. This requires mindfulness not as a trendy concept, but as a trading skill. Mindfulness slows down reaction time between emotion and action. It creates space for awareness, allowing the trader to respond to the market rather than react to it. Over time, this rewires the nervous system to tolerate uncertainty without panic. In trading, the edge isn't just analytical, it's emotional. The trader who can stay calm while others lose control holds the real advantage. But calmness isn't natural. It's trained. It comes from ritual, structure, and emotional conditioning. A consistent trader doesn't eliminate emotion, they align it. They turn fear into focus, doubt into discipline, and frustration into feedback. Emotional overload fades when the trader stops fighting emotion and starts mastering it. The truth is that every trader feels the storm. The difference lies in how they relate to it. Some drown in it, others surf it. Emotional overload turns the market into a battlefield. Emotional mastery turns it into a mirror. The faster a trader learns that the market doesn't test skill, it tests state, the faster they begin the real work of consistency. Emotional overload isn't a sign of weakness, it's a signal of untrained awareness. It's not the market that's too volatile. It's the trader's mind. The goal isn't to avoid the emotion but to remain unmoved by it, no matter how loud it gets inside the head. Inconsistency in trading often begins not with a bad strategy, but with a fragmented identity. Most traders enter the market chasing profits without ever forming a clear image of who they are within that environment. They don't understand their risk tolerance, their personality under pressure, or their behavioral patterns during uncertainty. They identify as someone trying to make money, rather than as a professional who operates with structure, rules, and self-awareness. This absence of identity leads to constant internal conflict, a trader trying to act like a disciplined executor while thinking like a gambler. The result is a mental split between intention and action, between what they know and what they actually do. The trading identity is the psychological foundation on which consistency is built. Without it, every decision feels unstable. When a trader lacks identity, they move through the market like a chameleon, adapting emotionally to every fluctuation, changing styles with every loss, and following every new trend or guru they come across. They keep asking, what works? Instead of asking, what works for me? This is the root of chronic inconsistency. Every strategy works in the right hands, but few traders ever stay long enough with one system to let it shape their behavior. Identity gives meaning to method. Without it, every method eventually collapses under emotional weight. At a deeper level, identity determines behavior automatically. In psychology, this is known as the self-concept loop. We act in alignment with who we believe we are. If a trader sees themselves as a beginner who's trying to make it, their subconscious constantly reinforces that role. They act like a beginner, hesitant, easily influenced, uncertain. When they see themselves as a risk taker, they unconsciously seek high volatility trades and ignore structure. The problem isn't the behavior itself. It's the identity that fuels it. Every trading action, whether rational or emotional, begins with a self-image that dictates what feels natural. The trader who hasn't defined who they are in the market is constantly shifting between conflicting identities, leading to erratic performance. Most traders unknowingly adopt external identities. They mimic the tone, style, or trading approach of others. They watch professional traders on social media, absorb their language, and assume that replicating someone's process will produce the same emotional resilience. But identity isn't something that can be copied. It must be built from within, through experience, reflection, and self-honesty. A scalper cannot trade like a swing trader if their nervous system thrives on quick decisions. A methodical, analytical mind will self-destruct in a high-frequency environment. Identity defines not only strategy, but the emotional ecosystem required to sustain it. The reason traders change systems so frequently is because they're not changing systems, they're changing identities. When a strategy stops working, they don't ask what went wrong internally, they assume the external method is flawed. They jump from technical to fundamental, from short-term to long-term, from indicators to price action, searching for a fit that feels right. But no system will feel stable until the trader does. A weak identity creates emotional dependency on results. Wins inflate confidence, losses erase it. Each fluctuation in performance shakes their sense of self. Instead of being the driver of their strategy, they become its passenger, emotionally tossed around by outcomes. The identity problem runs even deeper when tied to self-worth. Many traders attach their personal value to trading results. When they win, they feel intelligent, powerful, and validated. When they lose, they feel inadequate, lost, and undeserving. This emotional volatility mirrors their performance curve. A trader's sense of self becomes dependent on market approval, and this dependency erodes consistency faster than any technical error. They no longer trade to execute their edge, they trade to prove their worth. This is why even traders with profitable systems fail, because their identity is built around outcome, not process. In behavioral psychology, this is called external referencing, defining one's identity based on external factors like results or recognition. A trader who operates this way can never maintain internal equilibrium. The moment the market withdraws validation, emotional chaos follows. The alternative is internal referencing, where a trader's identity and confidence come from adherence to process and discipline, not profit. When the trader's identity is rooted in execution, they remain stable regardless of outcome. The market no longer defines them, their consistency does. Building a trader identity also involves understanding personal temperament. Some individuals are naturally patient, others impulsive. Some thrive under uncertainty, others need clear structure. Yet most traders never study their own temperament, they force themselves into styles that conflict with their psychological nature. A naturally reactive trader trying to trade long-term positions experiences psychological suffocation. They second-guess every candle, feel detached from the market, and lose confidence in their system. Conversely, a patient, methodical trader who forces themselves into scalping burns out under pressure. Trading style must align with identity, not the other way around. This misalignment often originates from the desire for quick gratification. Traders enter the market with dreams of freedom and wealth, believing that mastering a system will create success. But they forget that mastery isn't mechanical, it's psychological. The mind must evolve before the method does. Identity is the filter through which the trader interprets risk, reward, and probability. Without this filter, discipline cannot exist. Discipline without identity feels like punishment. But when discipline aligns with identity, it becomes self-expression. The trader no longer feels restricted by rules, they feel guided by them. Another aspect of identity confusion is the inability to separate the trader self from the human self. Outside the market, a person might be emotional, impulsive, or reactive, all normal traits. But when they bring these same characteristics into trading, the market amplifies them. Trading requires a psychological role shift, a transition into a mindset where emotion, opinion, and impulse have no place in execution. The trader who can compartmentalize these identities, who knows when to be analytical and when to be emotional, holds an enormous advantage. The lack of this separation is why traders overreact to losses. They take every losing trade personally, as if the market has insulted them. But the market doesn't know who they are, it only reflects their ability to remain aligned with their role. Identity also shapes perception of time. Inconsistent traders often act as if every trade determines their future. They think in short-term bursts of validation rather than long-term development. This short-term identity leads to destructive behavior, chasing trades, closing winners too early, or forcing setups out of boredom. A trader with a long-term identity operates differently. They understand that one trade is meaningless in the context of 1,000. They see losses as tuition, not trauma. This shift in temporal perspective is one of the defining traits of a professional mindset. One of the most destructive patterns caused by identity confusion is strategy hopping. The trader starts with one approach, loses a few trades, and immediately changes course. Each new system brings temporary hope, followed by inevitable frustration. They never realize that the problem isn't the strategy, it's the self trying to use it. Every system requires psychological alignment, and alignment comes from identity. Without it, even the best method becomes unstable. The trader isn't failing because the system doesn't work. They're failing because they haven't built the identity capable of executing it. The identity issue extends beyond performance. It affects recovery. When a trader with a weak identity experiences drawdown, they spiral into despair. They question their ability, purpose, and even belonging in the market. They lose motivation because their identity is attached to success, not resilience. In contrast, a trader with a solid identity sees drawdown as data. They detach emotion from analysis and focus on adjustment. This distinction determines who survives and who quits. The market doesn't eliminate traders through losses, it eliminates them through identity collapse. The psychological structure of identity also influences self-talk. The internal dialogue of a trader reveals how they perceive themselves. A trader without identity says, "I hope this trade works. I can't believe I messed up again," or "maybe this new system will fix everything." These statements reflect uncertainty and external dependency. A trader with identity speaks differently. "This setup matches my plan. That loss was within my parameters. I executed well even though it didn't work." The difference isn't in the result, but in the mental frame. Self-talk reinforces identity, and identity reinforces behavior. Over time, the language a trader uses becomes the blueprint for their psychology. Cognitive dissonance also plays a major role in identity instability. This occurs when a trader's actions contradict their beliefs. For example, they say they value patience but constantly jump into trades without confirmation. This internal contradiction creates psychological friction. The subconscious mind tries to restore balance, often through self-sabotage. The trader feels guilty, frustrated, or anxious without understanding why. To restore internal harmony, identity and behavior must align. When a trader's self-image matches their daily actions, emotional turbulence decreases. A lack of identity also makes traders highly suggestible. They seek validation from others, asking for confirmation on setups, joining trading groups for reassurance, or relying on external opinions to feel confident. This dependency weakens intuition and self-trust. True trading confidence doesn't come from being right. It comes from being congruent with one's identity. When a trader knows who they are, external noise loses influence. They don't need approval because they already have internal alignment. Identity formation requires introspection, an honest audit of who one is as a trader. What motivates you? What are you afraid of? Do you thrive in structure or creativity? Do you trade to prove something or to express skill? These questions cut deeper than technical analysis ever will. Most traders avoid them because they're uncomfortable. But without facing them, emotional triggers remain hidden and continue to dominate behavior. The journey from inconsistency to mastery isn't a search for new strategies, it's the excavation of self. One of the most overlooked aspects of trader identity is values. Every decision in trading reflects a hierarchy of values. A trader who values excitement over stability will subconsciously seek high-risk opportunities, regardless of logic. A trader who values security over growth will cut winners too early. These unconscious values shape risk tolerance, patience, and focus. Until a trader becomes aware of their value system, their behavior will always conflict with their intentions. Aligning values with goals is the essence of psychological consistency. Identity also determines how a trader handles uncertainty. A weak identity views uncertainty as a threat. A strong identity sees it as the natural environment of trading. The difference is perception. Uncertainty doesn't cause fear. Lack of self-trust does. When a trader knows who they are, Uncertainty loses its emotional sting. They don't need to control the market because they can control themselves. The market becomes a mirror, not a monster. A trader's identity evolves through experience, but only if they reflect consciously. Every loss, every emotional outburst, every mistake carries a lesson about self-image. The goal isn't to avoid these moments but to interpret them. The question shifts from, why did I lose? To, what part of my identity was triggered during that trade? Over time, this introspection transforms trading from a financial pursuit into a psychological craft. The trader no longer trades charts, they trade themselves. When identity is clear, behavior becomes predictable. Predictability breeds consistency. A trader who knows their patterns can anticipate emotional responses and neutralize them before they spiral. They understand their strengths, weaknesses, and limits. This self-knowledge creates a feedback loop of control. Every decision reinforces the identity of a disciplined, structured, and emotionally balanced trader. Over time, the market begins to reflect this inner stability through consistent performance. Without identity, trading is chaos disguised as ambition. With identity, it becomes discipline expressed through awareness. Identity transforms trading from a game of chance into a process of personal evolution. The trader's greatest edge isn't in predicting markets, but in defining themselves within them. Every trader wants consistent results, but few understand that results are only a reflection of internal state. The market doesn't reward skill alone, it rewards stability. A trader's emotional, mental, and physiological state at the moment of execution determines how effectively they perform. When that state fluctuates, so do the results. Consistency is not about having a perfect system, it's about maintaining a consistent internal environment that allows that system to function without interference. A trader can have the most refined strategy in the world, but if their mind is unstable, the strategy becomes a weapon turned against them. The chart doesn't test knowledge, it tests the nervous system. In trading psychology, the concept of state refers to the overall quality of consciousness, the combination of thoughts, emotions, energy, and focus that define how a person interacts with the market at any given moment. When this state is calm, clear, and centered, the trader sees opportunities objectively. When it is reactive, chaotic, or emotional, perception becomes distorted. The mind projects fears, hopes, and biases onto price action, transforming a neutral chart into a psychological battlefield. The same setup that looks perfect one day suddenly looks risky the next, not because the market changed, but because the trader's internal state did. The inconsistency in trading results can almost always be traced back to inconsistency in emotional state. A trader might execute flawlessly after a good night's sleep, a calm morning routine, and confidence from a recent win. But after a stressful day, a poor diet, or a losing streak, their state changes, they become impatient, doubtful, or reckless. They enter the same market with a different mind, and that difference changes everything. The market rewards those who can show up the same way every day, emotionally neutral, focused, and detached from outcome. Most traders can't, because they have never learned how to regulate their internal state. When a trader is in a peak state, fully aligned, calm, and confident, they experience what psychologists call flow. Time slows down, focus sharpens, and execution feels effortless. In this state, the mind and the market move together. There's no conflict between intention and action. But flow cannot be forced. It arises from balance. The moment a trader becomes anxious, distracted, or outcome-focused, the flow state collapses. They begin to overthink, hesitate, and interfere with their own edge. The transition from clarity to chaos happens in seconds, and most traders don't notice it until after they've made a mistake. The foundation of consistent trading performance lies in state awareness. Before a trader can control their state, they must first learn to recognize it. This means becoming aware of how the body and mind react under different conditions before, during, and after trades. Some traders notice tightness in their chest when they're about to overtrade. Others feel restless or experience rapid thoughts before a losing streak. These are not random sensations. They're signals from the body that the nervous system is shifting from regulation to stress. When ignored, these signals evolve into impulsive behavior. Awareness is the first line of defense against inconsistency. Inconsistent states are usually caused by three primary forces: emotional residue, physiological imbalance, and cognitive noise. Emotional residue is the leftover emotion from previous trades. A trader who loses a big position carries that emotional charge into the next session, whether they realize it or not. Even if they tell themselves they've moved on, the subconscious remains reactive. This emotional residue biases perception, creating either hypervigilance or recklessness. Physiological imbalance refers to how the body's condition, sleep, nutrition, stress, and hormones directly affects cognition. The brain consumes vast amounts of energy to maintain focus, and when the body is depleted, mental performance declines. Cognitive noise refers to the flood of unfiltered thoughts, doubts, and what-if scenarios that cloud judgment. Together, these forces create instability in the trader's internal system, making consistent decision-making impossible. To maintain a consistent state, the trader must approach the market as an athlete approaches competition. Physical state influences mental clarity, and mental clarity influences execution. Trading in a fatigued, overstimulated, or anxious state is like trying to run a marathon after drinking a pot of coffee. The energy is there, but it's erratic. The nervous system cannot differentiate between real and perceived stress. Every tick of price movement triggers a chemical reaction: adrenaline, cortisol, and dopamine that alters focus and decision-making speed. When these chemicals fluctuate uncontrollably, the trader's perception of opportunity and risk becomes distorted. One of the most dangerous emotional patterns in trading is the state shift caused by recent outcomes. After a string of wins, traders enter a state of euphoria. Their confidence inflates into overconfidence. They increase position size, loosen discipline, and start believing they can't lose. This state of emotional high is deceptive. It feels like strength, but is actually vulnerability disguised as momentum. The opposite occurs after a losing streak. The trader's state shifts into fear, hesitation, and self-doubt. They second-guess setups, reduce size excessively, or skip trades altogether. These alternating states, overconfidence and fear, create the illusion of inconsistency. But the problem isn't the market or the system. It's the emotional oscillation between extremes. True consistency emerges when a trader learns to depersonalize results. This doesn't mean being indifferent to profit and loss, but rather maintaining the same psychological baseline regardless of outcome. When wins don't inflate ego, and losses don't destroy confidence, emotional equilibrium stabilizes. From this equilibrium, consistent state naturally produces consistent behavior. Most traders, however, live in reaction to results. They wake up in different moods depending on whether yesterday was green or red. The subconscious begins associating worth with outcome, turning every trading day into an emotional test. Consistency cannot survive when the trader's sense of identity changes with each result. Another critical element of state regulation is environmental control. The trader's surroundings, physical space, lighting, noise, and even digital clutter influence focus and emotional tone. A messy trading setup creates subconscious tension. Constant alerts, news feeds, and chat rooms scatter attention. The mind, already struggling with uncertainty, becomes overstimulated. Overstimulation triggers anxiety, and anxiety triggers impulsivity. A controlled environment acts as an anchor for the mind. Minimalism in workspace leads to minimalism in thought. When the outer world is organized, the inner world follows. The physiology of state is equally important. Breathing patterns, posture, and heart rate directly affect mental state. Shallow breathing signals stress to the brain, activating the fight-or-flight response. Rapid heartbeat narrows focus and reduces logical reasoning. Simple physiological regulation, deep breathing, relaxation of the shoulders, controlled posture can reset the nervous system in seconds. Traders who master these micro-techniques can interrupt emotional spirals before they begin. The market might be chaotic, but the body can remain calm, creating psychological separation between stimulus and response. The inconsistency of state often comes from a deeper psychological issue: attachment. Traders become attached to outcomes, setups, or beliefs about how the market should behave. When reality contradicts these expectations, emotion floods the system. This attachment fuels frustration, anger, and despair. Detachment, on the other hand, preserves state. A detached trader doesn't mean a careless one. It means a trader who is fully engaged in execution but emotionally neutral about outcome. This is the mental posture of consistency, total focus without emotional investment. A common misconception is that traders must eliminate emotion to remain consistent. But emotion is not the enemy, it's the signal. Suppressing emotion leads to internal pressure that eventually explodes under stress. The key is regulation, not repression. Emotion should inform awareness, not dictate behavior. When a trader feels fear, it's an indicator to evaluate risk. When they feel greed, it's a reminder to maintain discipline. Emotions provide valuable feedback. They reveal the gap between current state and optimal state. The mistake most traders make is treating emotion as truth rather than data. To build a consistent state, routine becomes essential. The human mind thrives on structure. Pre-market rituals anchor the trader into a calm, focused mindset before exposure to uncertainty. This might involve meditation, journaling, reviewing setups, or simply breathing exercises. These rituals act as neural conditioning, training the brain to associate certain actions with specific mental states. Over time, the brain begins to enter trading mode automatically, reducing variability in emotional response. Without these rituals, the trader enters the market with whatever emotional baggage the day brings, leaving consistency to chance. Another layer of state management is cognitive priming. The thoughts and language a trader uses before and during trading shape their internal state. Negative self-talk, catastrophic thinking, or overanalysis create internal resistance. Statements like, "I can't lose again," or "this trade must work," load the nervous system with pressure. The focus shifts from process to protection, and performance suffers. Positive priming, such as affirmations of discipline, patience, and objectivity, reorients the brain toward execution. The subconscious mind follows dominant language patterns. Repeating constructive thoughts doesn't erase fear, but it weakens its hold. Inconsistent states are also reinforced by lifestyle habits. Excessive caffeine amplifies anxiety. Lack of exercise reduces emotional resilience. Poor sleep fragments attention and memory. Trading is a high-performance activity that demands physiological optimization. Every decision requires cognitive precision, and cognitive precision depends on body chemistry. The trader who neglects their body sabotages their mind. The nervous system cannot sustain clarity when overloaded with stimulants and stress hormones. Consistency in lifestyle translates into consistency in mental state. Another key to maintaining consistent state is recovery. The mind cannot remain in peak performance indefinitely. Every trading session drains emotional energy. Without proper recovery, rest, reflection, or disconnection, emotional fatigue accumulates. Fatigue distorts perception the same way alcohol does. It slows reaction time, clouds judgment, and amplifies emotion. Many traders mistake fatigue for boredom and continue trading, unknowingly operating at reduced awareness. A consistent trader understands that rest is part of discipline. They stop not because they're tired of the market, but because they respect the limits of their state. The deeper psychological mechanism behind inconsistent state is the lack of emotional neutrality. Humans are conditioned to seek pleasure and avoid pain. In trading, this instinct manifests as chasing winners and avoiding losses. Each of these impulses disturbs equilibrium. The trader's state becomes reactive, elevated during wins and depressed during losses. Emotional neutrality means experiencing both without internal fluctuation. It's the art of remaining centered regardless of external conditions. This neutrality doesn't dull emotion. It refines it into awareness. From neutrality, clarity arises. From clarity, consistent decisions follow. One of the most profound realizations a trader can have is that performance is not a function of market conditions, but of psychological readiness. The same setup traded by two people in different states produces opposite outcomes. One sees opportunity, the other sees risk. One acts decisively, the other hesitates. The difference isn't the chart, it's the internal lens through which it's viewed. This is why journaling emotional state is as important as journaling trade entries. Recording thoughts, feelings, and energy levels creates a map of internal patterns. Over time, the trader begins to see correlations between certain states and performance outcomes. Once identified, these states can be replicated or avoided. Inconsistent results are never random. They are predictable expressions of inconsistent state. The trader who treats trading as an emotional mirror begins to see that every spike of frustration, every burst of excitement, and every moment of hesitation reflects their current level of regulation. The work of trading is not just analyzing the market but mastering the inner world from which all decisions originate. When the internal state stabilizes, the external results follow naturally, because the market becomes a reflection of psychological order rather than emotional chaos. In the world of trading, the greatest illusion is that more information equals better performance. Traders chase endless streams of data, new indicators, updated algorithms, alternative market theories, fresh YouTube tutorials, economic reports, Discord signals, believing that somewhere in the noise lies the secret to consistency. They convince themselves that the next piece of information will be the missing puzzle, the key that unlocks permanent success. But this obsession with more is exactly what destroys their ability to perform. Over-optimization and information addiction are the silent killers of trading consistency, and they operate not through ignorance, but through excess. The mind of the modern trader is constantly overstimulated. The market itself already generates uncertainty and emotional volatility, but the trader amplifies it by consuming too much. Every new video, strategy, or data feed triggers cognitive dissonance, a conflict between what they already know and what they're now exposed to. This internal conflict leads to doubt, and doubt leads to paralysis. When a trader is addicted to information, they can no longer trust themselves. They start questioning their system after every loss, tweaking entries, changing stops, switching brokers, adjusting indicators, and overanalyzing results that were never statistically significant in the first place. Their identity becomes tied not to execution, but to exploration, forever learning, never mastering. Over-optimization is the behavioral expression of this addiction. It's the tendency to constantly tweak a trading system to fit the most recent data, under the illusion that perfection exists. The trader backtests strategies until the curve fits perfectly, showing unrealistic results that will never hold in real time. The backtest becomes an ego massage rather than a performance tool. In doing so, the trader removes randomness from history, but randomness is what defines the real market. The moment the system meets live conditions, it collapses because it was built on a fantasy of certainty. This is the paradox of over-optimization. The more precise the system becomes, the less adaptable it is to reality. At the psychological level, over-optimization is driven by fear, the fear of uncertainty, loss, and lack of control. The trader believes that if they just analyze enough data, if they just tweak enough parameters, they can eliminate risk. But risk is not a variable to be removed, it's the foundation of the market. Every attempt to escape uncertainty is an act of resistance against the nature of trading itself. The more a trader tries to control every possible outcome, the more fragile they become. One unexpected event, one deviation, and the illusion of control shatters. Instead of learning to adapt, they double down on optimization, tightening their system even more, which ironically increases their vulnerability. Information addiction operates in cycles, similar to other behavioral addictions. The trader consumes new content to feel productive. The act of learning releases dopamine, a neurochemical associated with pleasure and motivation. Each new piece of information provides temporary relief from the discomfort of uncertainty. It feels like progress, even when no real progress is being made. But dopamine is short-lived. Once it fades, the trader feels anxious again, driven to seek more information to recreate the sense of control. The cycle repeats indefinitely: consumption, comfort, doubt, more consumption. In the process, the trader becomes intellectually bloated and operationally starved. They know more than ever but execute worse than before. This addiction also distorts perception. The trader begins to believe that success lies in external knowledge rather than internal discipline. They start to idolize others who appear more informed, more experienced, or more confident. They chase courses, mentorships, and communities, not to deepen understanding but to outsource responsibility. They think, if I just learn what that person knows, I'll succeed. But trading doesn't reward knowledge alone, it rewards behavior. A trader who reads 10 books on discipline but can't hold a trade through a pullback hasn't learned discipline, they've intellectualized it. Information without embodiment becomes noise, and the more noise the mind consumes, the less signal it can process. Over-optimization also destroys intuition. Intuition in trading isn't mysticism. It's pattern recognition developed through experience. When a trader is constantly changing their system, they never allow their subconscious mind to learn those patterns. Intuition requires repetition and familiarity. Each time the trader alters indicators or switches strategies, they reset their learning curve. Their brain can't form stable associations between setups, outcomes, and emotions. They remain stuck in perpetual beginner mode, intellectually advanced but emotionally untrained. Consistency requires not more information, but fewer variables repeated consistently over time. The deeper danger of information addiction is the illusion of certainty it creates. The human brain craves closure. When something feels uncertain, it triggers anxiety, and information serves as a temporary tranquilizer. The trader reads more to avoid feeling lost, but this pursuit of certainty leads to overanalysis. Instead of responding to the market, the trader tries to predict it. They create dozens of scenarios, trying to anticipate every possible move. This mental overload freezes decision-making. By the time they decide, the opportunity has passed. They then interpret the missed trade as failure, which reinforces the need for more study. Each layer of analysis adds another wall between the trader and action. Over-optimization also manifests in perfectionism. The trader believes they can't execute unless everything aligns perfectly, every indicator confirming, every candle closing exactly right, every condition met without flaw. But the market never gives perfect clarity. It only offers probabilities. Waiting for perfection leads to hesitation. Hesitation leads to missed trades, and missed trades lead to frustration. Perfectionism is emotional avoidance disguised as professionalism. It's the subconscious fear of being wrong. The trader wants to eliminate the possibility of loss before they act, but by waiting for perfect confirmation, they lose the opportunity itself. The irony of over-optimization is that it gives traders a sense of safety while eroding their confidence. The more complex a system becomes, the more fragile the trader's belief in it. Every new filter or tweak introduces another potential failure point. The trader begins to doubt whether their system is ready, constantly testing and modifying. They never realize that consistency doesn't come from the system's perfection, but from the trader's ability to remain consistent with an imperfect system. Every successful trader knows that no system is flawless. The key is learning to manage imperfection, not eliminate it. Information addiction also undermines focus. When a trader consumes too much, their mental bandwidth fragments. They start the day analyzing macroeconomic trends, shift to watching scalping tutorials by noon, and end the day backtesting a swing strategy. Their brain jumps between frameworks, unable to form a cohesive narrative. Focus is the currency of performance, and addiction to information spends it recklessly. Each time the mind switches context, it drains energy. Over time, this mental exhaustion creates burnout disguised as busyness. The trader feels overwhelmed, not because trading is hard, but because their mind is overfed and under-disciplined. There's also an emotional comfort in collecting information. It postpones accountability. As long as the trader is learning, they don't have to face the discomfort of execution. They can rationalize failure by saying they're still in the learning phase. This comfort zone becomes a psychological trap. Months, even years, pass without progress, because the trader mistakes study for practice. They confuse understanding with mastery. In reality, trading doesn't reward the one who knows the most, but the one who acts with clarity. Every moment spent searching for more data is a moment stolen from the development of confidence through repetition. The subconscious motive behind over-optimization is often self-sabotage. Traders who fear failure unconsciously delay success by keeping themselves perpetually in progress. They believe that if they never fully commit to one system, they can never truly fail, because they can always claim they're still improving. But this mindset ensures they'll never succeed either. Consistency requires commitment, and commitment requires the courage to face imperfection. When a trader refuses to commit, they're not protecting themselves from loss, they're protecting their ego from accountability. In trading psychology, the need for excessive information often stems from low tolerance for uncertainty. Humans are biologically wired to avoid ambiguity. In prehistoric times, uncertainty equaled danger. But in markets, uncertainty is the normal environment. A trader with low uncertainty tolerance tries to fill that void with knowledge, believing that understanding more will make the unknown disappear. But the unknown can't be eliminated, it can only be accepted. The trader's real task is not to know everything but to function effectively despite not knowing. That is the essence of mental toughness. The constant search for new information also fragments belief systems. Each new piece of content carries an implicit worldview, a way of interpreting the market. One trader believes in fundamentals, another in technicals, another in sentiment, another in volume profile. When a trader consumes all these perspectives without integration, they create internal conflict. Their mind becomes a collage of contradictory ideas, none fully tested, all equally loud. When they sit in front of the chart, their brain becomes a debate hall instead of a decision center. Clarity disappears. In this confusion, hesitation becomes the dominant behavior, and hesitation is the death of opportunity. Over-optimization also erodes patience. Traders accustomed to constant stimulation find it difficult to wait for setups. The quiet periods between trades feel unbearable. Their dopamine-conditioned minds crave action, so they force trades to feel productive. These impulsive trades often lead to losses, which reinforce emotional instability. The cycle continues. Boredom leads to action. Action leads to loss. Loss leads to more over-optimization. The trader becomes a prisoner of restlessness, unable to sit still long enough for real probability to unfold. At the neuropsychological level, information addiction reshapes attention span. The constant influx of stimuli shortens focus and increases mental fatigue. The brain's reward system starts prioritizing novelty over mastery. Every time the trader consumes something new, the brain releases dopamine, reinforcing the behavior. But mastery requires repetition, the opposite of novelty. This creates a direct conflict within the trader's mind. Their biology wants new stimulation, but their craft demands deep, repetitive focus. Unless they consciously recondition themselves to tolerate repetition, they'll forever chase information instead of progress. One of the most damaging aspects of over-optimization is the destruction of emotional feedback loops. Trading success relies on self-awareness, the ability to connect emotional states with market outcomes. When a trader constantly changes their approach, they never collect enough emotional data to build self-understanding. They don't know what triggers fear, greed, or hesitation because the context changes too often. Emotional mastery depends on familiarity, and familiarity depends on consistency. A trader who changes too frequently never sees the full picture of their psychology. In a deeper sense, over-optimization reflects a lack of trust, not in the market but in oneself. The trader doesn't trust their ability to handle randomness. They don't trust their capacity to stay disciplined under pressure. They don't trust that consistency comes from within. So they seek external systems to give them that trust artificially. But external systems can't provide internal security. Confidence that depends on conditions is fragile. Confidence that comes from acceptance is unbreakable. The trader who truly trusts themselves doesn't need constant optimization because they know their edge isn't in perfection, but in persistence. Ultimately, the addiction to information is a fear response disguised as intellectual pursuit. It's the mind's attempt to escape uncertainty by drowning in data. The trader mistakes movement for progress, knowledge for wisdom, and activity for mastery. Yet, true trading excellence is subtractive, not additive. It's the process of removing distractions, simplifying strategy, and deepening focus. Every piece of unnecessary information adds noise. Every layer of complexity adds fragility. The trader's real evolution begins the moment they stop seeking more and start refining less. Trading, at its core, is a performance-based discipline. It requires not just knowledge of markets but mastery of self. Yet, most traders spend their entire careers analyzing everything except themselves. They dissect charts, study price action, watch indicators, and interpret news, but rarely stop to observe the real engine behind every trade: their own mind. This absence of self-analysis creates a psychological blind spot that prevents growth. Without a feedback loop, no behavior can improve. In trading, the lack of feedback loops ensures one thing: the same mistakes repeat indefinitely, disguised as bad luck or market manipulation. A feedback loop, in its simplest form, is a process of reflection and correction. It's the mechanism through which an action produces a result. The result is analyzed, and the insights from that analysis are used to adjust the next action. Every high-performance field, from athletics to engineering to neuroscience, depends on feedback loops for improvement. Yet, in trading, most people ignore this process entirely. They trade, lose or win, and move on without truly examining the why behind their outcomes. Their focus stays external on the market, not on their behavior. Over time, this creates a widening gap between experience and wisdom. The trader might gain hours of screen time, but they don't gain insight. Inconsistent traders live inside what psychologists call the illusion of progress. They believe that time spent trading equals improvement. But time doesn't teach. Reflection does. Without structured feedback, the brain cannot distinguish between effective and ineffective behavior. It simply repeats what's familiar. That's why traders keep making the same emotional mistakes: chasing trades, exiting too early, moving stops, or taking impulsive positions after losses. The conscious mind tells them to stop, but the subconscious mind runs on autopilot because it has never been properly reprogrammed. Feedback loops are the mechanism that rewires this autopilot. The lack of feedback loops also creates an emotional disconnect from performance. When traders don't review their behavior, their perception of reality becomes distorted. A loss feels catastrophic, a win feels euphoric, and both are misinterpreted emotionally instead of analytically. The trader starts assigning meaning to randomness, believing they're on a hot streak, or the market is against them. But these are narratives, not data. A feedback loop replaces narrative with evidence. It turns trading from an emotional experience into a measurable process. Without it, traders live inside stories rather than systems. At a deeper psychological level, the absence of feedback loops is often rooted in avoidance. Reviewing trades requires confronting mistakes, and confrontation threatens the ego. The ego seeks protection from pain, not growth from truth. So, traders subconsciously avoid reviewing their trades because it forces them to see patterns they'd rather ignore: impulsivity, lack of discipline, inconsistency, or fear. This avoidance feels safe in the short term but fatal in the long term. A trader who doesn't measure their behavior is like a pilot who refuses to check the instruments mid-flight. Eventually, disorientation leads to a crash. A functional feedback loop in trading consists of 3 stages: awareness, documentation, and correction. Awareness is recognizing the emotional and behavioral patterns during and after execution. Documentation is capturing those patterns objectively through journaling, voice notes, or screen recordings. Correction is the deliberate process of designing behavioral adjustments based on what was observed. Most traders skip all 3. They rely on memory, which is biased and selective. Memory amplifies emotional experiences and suppresses neutral data. As a result, traders remember the pain of a big loss, but forget the small mistakes that caused it. Without records, there's nothing to analyze, and without analysis, there's nothing to fix. One of the most effective tools for building feedback loops is a trading journal, not just for recording entries and exits, but for documenting mental states. The journal isn't a scorecard, it's a mirror. Each entry reveals the trader's psychological condition at the time of execution. Patterns begin to emerge: fear-based exits, greed-driven entries, hesitation during drawdowns, revenge trading after losses. These aren't random behaviors, they're feedback. They show the trader exactly where their emotional system hijacks logic. Over time, this data becomes more valuable than any technical indicator because it maps the trader's internal landscape. The brain learns best through immediate feedback. In trading, feedback is often delayed. You might take a trade today and see the result hours or days later. This delay creates a disconnect between cause and effect, weakening learning. That's why active reflection is essential. Writing down thoughts right after each trade bridges the gap between action and result. It captures raw emotion before rationalization distorts it. Later, when reviewing, the trader can see the difference between perception and reality. This builds emotional awareness, the foundation of consistency. Another reason traders resist feedback loops is because they confuse reviewing with judging. They fear that analyzing mistakes will lower confidence. But feedback isn't criticism. It's calibration. A pilot doesn't feel shame when checking altitude, they simply adjust. Similarly, a trader must approach self-review without emotion. The goal isn't to punish errors but to understand them. Every mistake contains information about state, timing, and mindset. When analyzed without ego, mistakes become data points that refine intuition. Without this process, emotion becomes the teacher, and emotion teaches inconsistency. Feedback loops also expose behavioral biases, the unconscious mental shortcuts that distort perception. Traders often suffer from confirmation bias, seeking information that supports their opinions while ignoring contradictory data. They fall into recency bias, giving more weight to recent outcomes than to overall statistics. They experience loss aversion, valuing the avoidance of pain over potential gain. Without feedback mechanisms, these biases go unchecked. But when a trader reviews patterns objectively, the biases become visible. Recognizing them weakens their power. Lack of feedback loops also destroys accountability. Without tracking performance and psychology, there's no measurable standard. The trader can't distinguish between luck and skill, between progress and stagnation. They attribute wins to intelligence and losses to bad luck, keeping themselves trapped in an externalized mindset. Feedback reinstates internal control. It forces the trader to accept responsibility for results, whether positive or negative. Once responsibility is internalized, improvement becomes possible because the trader stops waiting for external conditions to change and begins changing themselves. The emotional benefits of feedback loops are profound. Regular review reduces anxiety because it creates clarity. The unknown always breeds fear, but when a trader understands why they win and lose, uncertainty loses its emotional charge. Patterns replace chaos, and structure replaces confusion. The mind functions best in predictable environments, and feedback loops create predictability within performance. Even if the market remains uncertain, the trader's behavior becomes stable. That internal stability becomes the anchor during volatility. At the neurological level, feedback strengthens neural pathways related to decision-making. Each review session activates memory and reflection circuits in the prefrontal cortex, the brain region, responsible for rational analysis and emotional regulation. Over time, this rewiring makes logical thinking more automatic during live trading. The trader begins to catch impulsive thoughts before acting on them. They develop what psychologists call metacognition, the ability to think about one's own thinking. This awareness turns reaction into response. A lack of feedback also prevents the development of adaptive learning, the ability to evolve under changing market conditions. The market is dynamic, but adaptation requires awareness of one's current limitations. Without feedback, traders keep applying outdated strategies to new conditions, mistaking stubbornness for discipline. They stop evolving because they don't know what to evolve from. The feedback loop closes that gap by providing real-time information about performance under current conditions, enabling continuous refinement rather than blind persistence. Feedback loops can also be expanded beyond individual trades into emotional cycles. For example, a trader might notice through journaling that they perform poorly every time they trade after a stressful day or without adequate sleep. This insight becomes actionable data. They learn that emotional fatigue correlates with loss. By tracking such patterns, traders can begin managing not only trades but states. Over time, they build an internal checklist: mental clarity, emotional neutrality, physical readiness. This transforms trading from a random pursuit into a structured psychological process. The absence of feedback loops also perpetuates the illusion of bad days. Traders label sessions as unlucky or manipulated, using external excuses to avoid introspection. But consistent journaling often reveals that bad days share common factors: lack of focus, emotional residue from previous losses, deviation from rules, or overconfidence after wins. These aren't coincidences. They're behavioral patterns disguised as randomness. Without feedback, these patterns remain invisible. And invisible behavior can't be corrected. In performance psychology, feedback loops serve a deeper function. They regulate self-image. Every trader has an internal identity, who they believe they are in the market. Without feedback, that identity remains static and often unrealistic. They see themselves as disciplined even when they aren't, or as unlucky when they're simply undisciplined. Feedback realigns self-image with reality. It shows the trader not who they think they are, but who they actually are through data and behavior. This alignment between identity and action creates authenticity, and authenticity is the root of confidence. The most successful traders treat feedback as part of execution, not as an afterthought. For them, the trading process doesn't end when the trade closes, it ends when the lesson is extracted. Each day becomes a mini laboratory of psychological data. This approach transforms trading from a reactive cycle into a self-evolving system. They don't just trade markets, they trade their own improvement. The market provides the test, but the feedback loop provides the transformation. Without feedback, traders also become emotionally dependent on the fair, outcome-based validation. They need wins to feel competent. But when they implement feedback loops, they shift from result-based satisfaction to process-based fulfillment. Improvement itself becomes rewarding. The emotional highs and lows flatten, replaced by steady internal motivation. This stability reduces burnout and increases focus because the trader no longer seeks excitement from results but satisfaction from refinement. Feedback loops also improve risk management. When traders review their performance consistently, they begin to see how their emotional state influences position sizing and risk decisions. They notice tendencies taking larger positions after wins, reducing risk after losses, or abandoning stops under stress. These realizations lead to structured corrections, like fixed percentage risk rules or pre-commitment contracts. Over time, risk management becomes instinctive, not forced. One of the biggest misconceptions about feedback is that it slows progress. Many traders think reflection wastes time that could be used trading. But in reality, feedback accelerates learning by compressing experience. Instead of taking years to notice recurring mistakes, a trader who reviews daily learns the same lesson in weeks. Feedback multiplies the value of each experience by turning it into knowledge. Without it, experience remains just repetition, a loop of errors mistaken for effort. The feedback loop also creates emotional detachment. When traders review performance objectively, they start seeing patterns rather than personal failures. A losing trade no longer defines their worth, it becomes data. This shift from emotional to analytical interpretation builds resilience. The trader stops internalizing losses and starts using them as feedback signals. Every loss becomes a message instead of a wound. This mindset marks the transition from amateur to professional. Technology has made it easier than ever to build feedback systems, screen recording, journaling software, trade analytics platforms. Yet the problem persists because the resistance isn't technical, it's psychological. Feedback demands honesty, and honesty threatens the ego. The ego resists change because it equates self-evaluation with self-criticism. But in trading, avoiding self-evaluation is self-destruction. The trader must learn to detach self-worth from performance metrics. Feedback isn't about proving value, it's about improving awareness. Ultimately, the absence of feedback loops keeps traders trapped in the first level of awareness reaction. They react to price, to emotion, to outcome. Feedback moves them to the second level reflection, where they observe those reactions and extract meaning. Mastery begins at the third level regulation, where observation becomes control. This evolution is impossible without structured self-assessment. Feedback is not a luxury or an advanced concept, it's the foundation of psychological growth. Trading without feedback is like navigating with a blindfold. You might move, but you'll never know why or where you're going. Every trader begins their journey believing that success lies in understanding the market. They think the secret is hidden in indicators, patterns, algorithms, or technical mastery. But as time passes and the emotional storms of trading begin to hit, A realization slowly emerges. The problem was never the chart, it was the mind interpreting it. Consistency does not come from better tools or more knowledge, it comes from a mind that is stable, disciplined, and self-aware. Before any strategy can work, the trader's psychology must be rewired to support it. The real fast fix is not about finding the right entry signal, it's about conditioning the mind to execute with emotional neutrality, regardless of external chaos. Reprogramming the mind begins with understanding how it currently functions. The average trader operates on subconscious patterns built long before they ever opened a chart. Their relationship with money, risk, and failure was shaped by childhood experiences, social conditioning, and personal identity. When they start trading, they don't bring a blank slate, they bring a lifetime of beliefs about success, fear, and control. These beliefs dictate behavior more powerfully than any conscious logic. A trader who unconsciously associates loss with shame will always avoid taking necessary risks. A trader who equates winning with self-worth will self-sabotage the moment they start doing well, because the subconscious mind fears losing that validation. The process of reprogramming starts by exposing these hidden programs. The human brain is designed for survival, not consistency. In the wild, reacting quickly to danger kept humans alive. But in markets, that same instinct becomes destruction. The fight or flight response that once saved lives now destroys accounts. Each trade triggers micro-survival responses. Fear when price moves against you, greed when it moves in your favor, hesitation when uncertainty increases. These reactions bypass logic because they originate in the amygdala, the brain's emotional center, not the rational prefrontal cortex. Reprogramming means teaching the brain that trading is not a threat to survival. It means rewiring the emotional responses that interpret volatility as danger. To reprogram effectively, a trader must first bring unconscious behavior into consciousness. This is done through observation without judgment. Every time an impulsive action occurs, entering early, exiting too soon, revenge trading, the goal isn't to suppress it but to observe it as data. The moment awareness enters, change begins. Neuroscience shows that conscious observation weakens automatic neural patterns. When a trader observes an emotional impulse without reacting, they interrupt the pattern. Over time, this repetition forms new neural pathways. Calm replaces panic, patience replaces urgency, detachment replaces fixation. This is how the brain rewires through awareness rather than force. Most traders try to change behavior through willpower alone. They promise themselves they'll be more disciplined tomorrow, only to repeat the same mistakes. Willpower is weak against deeply conditioned emotional patterns. It functions in the conscious mind, which accounts for only a small fraction of decision-making. The subconscious, however, controls behavior automatically. To achieve real transformation, a trader must reprogram the subconscious not through effort, but through consistent conditioning. This involves repetition, visualization, and emotional anchoring. Just as an athlete trains muscle memory, a trader must train mental memory until discipline becomes instinct. Visualization is one of the most powerful tools for mental reprogramming. When vividly imagined, the brain activates the same neural circuits as real experiences. A trader who visualizes executing with patience and composure literally rewires their brain to normalize those behaviors. The subconscious doesn't distinguish between imagined and real experiences, it accepts both as truth. By repeatedly visualizing calm execution under pressure, the trader creates new associations. Market volatility no longer triggers panic, it triggers focus. Over time, these mental rehearsals become embodied reactions. Emotional anchoring complements this process. This technique involves connecting a desired state such as calm or confidence to a physical cue, like breathing deeply or touching a specific object. By repeatedly pairing the emotion with the cue, the brain learns to activate that emotional state automatically. During live trading, the trader can then trigger calmness instantly by using the cue. This bypasses emotional chaos and restores clarity. These methods may seem simple, but their effects are profound because they work at the level where behavior originates the nervous system. Reprogramming also requires changing the internal language that shapes thought. Every trader speaks to themselves constantly, often unconsciously. I always mess up when I trade news, I can't hold winners, I'm not consistent. These statements become self-fulfilling because the subconscious mind treats them as commands. The more the trader repeats them, the more the brain reinforces them through confirmation bias. To break this loop, internal dialogue must shift from identity-based limitation to process-based empowerment. Instead of, I can't manage risk, it becomes, I am learning to manage risk with precision. The mind begins to adopt the new identity it's being fed. Over time, this internal narrative becomes a psychological compass that directs behavior. The subconscious mind is programmable through emotion and repetition. Every emotional reaction in trading strengthens a belief. That's why losing streaks often spiral, not because of the trades themselves, but because of the emotions attached to them. The trader begins to believe they are in a slump, and the subconscious aligns behavior to match that identity. To reprogram this, emotion must be redirected. After a loss, instead of reinforcing frustration, the trader practices neutrality, analyzing it as data, not failure. This repetition teaches the subconscious that loss is normal, not threatening. The nervous system eventually adapts, and emotional equilibrium becomes the default response. The mind can only focus on what it has been trained to value. Most traders unconsciously value excitement more than consistency. They may say they want discipline, but their nervous system craves adrenaline. This craving keeps them locked in impulsive cycles, because the body literally becomes addicted to the chemicals released during high-stress trading: adrenaline, cortisol, dopamine. The subconscious begins to equate volatility with stimulation, mistaking it for progress. Reprogramming means detoxing from this addiction. The trader must learn to find satisfaction in calmness, not chaos. Consistency becomes emotionally rewarding only when the nervous system is trained to associate peace with success instead of boredom. This shift requires reframing how the trader experiences trading itself. For most, trading is treated as a battleground, them versus the market. This adversarial mindset activates aggression and defensiveness. But the market is neutral. It's not an enemy to defeat, but a mirror to understand. When a trader stops fighting the market and begins observing it as feedback, emotion drops and objectivity rises. This is a fundamental psychological reframe that changes physiology in real time. Stress hormones decline, focus improves, and the trader's state stabilizes. Reprogramming the mind starts with changing the relationship with uncertainty from resistance to cooperation. Journaling accelerates reprogramming because it externalizes internal chaos. Writing down thoughts and emotions after each session transforms them from subconscious impulses into conscious data. The act of documenting creates detachment. A thought that once felt overwhelming becomes manageable once written. Over time, journaling reveals patterns, emotional triggers, recurring fears, irrational beliefs. Each entry becomes a mirror that reflects the structure of the subconscious. Once seen clearly, these patterns lose their control. Awareness transforms them from invisible masters into visible servants. Affirmations are another component of mental reprogramming, though they only work when aligned with belief. Repeating, "I'm a confident trader," means nothing if the subconscious rejects it. To make affirmations effective, they must be believable and emotionally charged. The mind resists statements that feel false but accepts those that feel possible. For example, instead of affirming perfection, a trader might affirm progress. "Every day I am becoming more focused and disciplined." The subconscious can accept gradual evolution because it doesn't trigger resistance. Over time, these incremental affirmations reshape identity through repetition. The fast fix in trading psychology is not about speed but efficiency. Emotional conditioning works faster than intellectual learning because it speaks the language of the subconscious: imagery, repetition, and emotion. The mind learns through association, not logic. By pairing new beliefs with powerful emotional states, transformation accelerates. This is why traders who engage in mental training, meditation, visualization, self-dialogue evolve faster than those who only study charts. They're rewiring the source code, not the surface behavior. Meditation plays a crucial role in reprogramming because it trains the mind to observe without reaction. The practice of mindfulness strengthens the prefrontal cortex, the part of the brain responsible for self-regulation. Through meditation, the trader learns to create space between thought and action. This space is where control exists. Each time they notice an impulse but choose not to act, they reinforce neural pathways of discipline. Over time, the mind stops reacting automatically. Calmness becomes a habit, not an effort. Meditation doesn't eliminate emotion, it refines it into awareness. Breathing techniques enhance this process by directly influencing physiology. The breath is the remote control of the nervous system. Slow, deep breathing activates the parasympathetic system, the body's natural relaxation response, lowering cortisol and heart rate. During volatile markets, conscious breathing can restore equilibrium in seconds. This practice connects the physical and psychological layers of reprogramming, teaching the body and mind to operate in coherence rather than conflict. Another layer of reprogramming involves redefining failure. Most traders internalize losses as proof of incompetence. This belief creates emotional resistance to risk. But failure is not the opposite of success. It's the path to it. Every mistake provides feedback on both market understanding and psychological state. When traders begin to view losses as information rather than injury, they rewire their emotional associations with risk. The subconscious stops interpreting losing as pain and starts seeing it as process. This removes fear, the single greatest barrier to consistent execution. Reprogramming also requires setting clear identity statements. A trader without identity is easily swayed by results. One day they feel confident, the next they feel lost. But when they define who they are not as someone trying to win, but as someone who executes with discipline, their actions align automatically. The subconscious needs identity to organize behavior. Once that identity is set, every decision filters through it. For example, the identity of a professional executor automatically rejects impulsive actions because they contradict the role. Identity becomes the anchor that holds behavior steady amidst volatility. The environment plays an equally critical role in mental reprogramming. The mind absorbs signals from surroundings, clutter, lighting, noise, even digital distractions. A chaotic environment reinforces chaotic thinking. A minimalist workspace communicates order and focus to the subconscious. This principle extends to digital consumption as well. Constant exposure to trading groups, opinions, and noise conditions the mind toward dependency and confusion. Reprogramming requires intentional control of input, consuming less, observing more, creating internal silence. The quieter the mind, the faster it reconditions. Neuroplasticity, the brain's ability to reorganize itself through experience, ensures that mental reprogramming is not theoretical. The brain physically changes in response to thought patterns. Each time a trader replaces reaction with awareness, they strengthen neural networks of discipline. Each visualization of composure under stress builds new connections that override old fear responses. Over time, these neural changes accumulate into behavioral transformation. What was once reactive becomes automatic calm. The brain literally rewires itself to trade from clarity instead of chaos. Sleep and recovery are essential to this process. Reprogramming requires integration, and integration happens during rest. During deep sleep, the brain consolidates memories and neural adjustments from the day. A trader who neglects rest sabotages their own rewiring. Fatigue reverses progress by weakening emotional control and cognitive precision. Reprogramming isn't about doing more, it's about doing the right things consistently while allowing the mind to absorb them. Consistency itself is a form of programming. Every repeated behavior, thought, or emotion teaches the brain what's normal. If inconsistency is repeated daily, the brain normalizes it. If discipline is repeated daily, it becomes automatic. The subconscious doesn't distinguish between good and bad habits. It simply reinforces whatever it experiences most often. This means reprogramming isn't a dramatic overhaul, but a daily commitment to repetition. The brain changes through consistent exposure to stability. Ultimately, reprogramming the mind before the chart means shifting focus from external mastery to internal alignment. The market will always be uncertain, but the trader's internal environment can be conditioned to remain stable. When the mind is calm, the chart becomes clear. When emotion is regulated, probabilities become visible. The trader stops searching for the perfect system because they realize the real system is their psychology. Every market condition becomes manageable once the internal operating system is optimized for patience, detachment, and self-control. The fast fix is not a shortcut. It's a direct route. Recondition the operator, and the operation fixes itself. Every trader eventually reaches a point where the market stops feeling like an external opponent and starts to look like a mirror. What they see on the chart is no longer just price movement, it's a reflection of their thoughts, beliefs, fears, and impulses. The candlesticks rise and fall, but beneath every move is a mirror reflecting who the trader truly is under pressure. The greatest realization in trading is that the market doesn't create emotion, it exposes it. It reveals discipline or the lack of it, patience or impatience, confidence or insecurity. This is what can be called the mirror effect. The moment the trader recognizes that every win, loss, hesitation, or overreaction originates within themselves, not from the market, the mirror effect strips away the illusion of external control. It forces the trader to see that the chaos they perceive in the market is often a projection of their internal chaos. When the mind is unsettled, the chart feels unpredictable. When the mind is calm, the same chart looks orderly. The trader's internal state determines perception far more than price movement does. Two traders can look at the same setup. One sees clarity, the other sees confusion. The difference lies in their emotional lens. This realization transforms trading from a technical pursuit into a psychological journey, an exploration not of markets but of self-awareness. Many traders resist this truth because it requires radical responsibility. It's easier to blame volatility, brokers, or news events than to confront one's own lack of regulation. But avoidance keeps them trapped in cycles of frustration. The moment they accept that every recurring mistake originates internally, change becomes possible. The mirror effect is uncomfortable because it eliminates excuses. Every hesitation exposes doubt, every impulsive entry reveals impatience, every over-leveraged position uncovers greed. But within that discomfort lies power. When a trader takes ownership of their reactions, they reclaim control from the market. The market, in truth, has no memory, no emotion, and no bias. It doesn't care who trades or how much they win or lose. It is pure neutrality. Yet, the trader approaches it with personal baggage, the desire to prove something, the fear of being wrong, the need for validation. These psychological burdens distort perception. The chart becomes a canvas where the trader paints their own mental patterns. A fearful trader will always see potential danger. A greedy trader will always see potential opportunity. And a disciplined trader will see only structure. The mirror effect reveals that every interpretation of the market is a reflection of internal conditioning. Understanding this dynamic changes how traders respond to setbacks. Instead of seeing a losing trade as failure, they begin to view it as feedback, a signal about their own state. A loss after breaking rules is not about bad luck, it's about the inability to regulate impulse. A missed entry isn't about market manipulation, it's about hesitation rooted in self-doubt. Each moment becomes a lesson in self-awareness. The mirror effect turns every market session into a form of psychological training, where the goal is not to conquer the market but to refine the self that interacts with it. This perspective also transforms the relationship between emotion and execution. Emotion no longer needs to be suppressed or feared, it becomes a diagnostic tool. Anger reveals attachment. Anxiety reveals uncertainty. Overconfidence reveals lack of humility. When observed consciously, emotion turns into information. The trader learns to read their own internal signals the same way they read the chart. Just as they identify trends and reversals in price action, they begin to identify patterns in their mindset, the repetitive cycles of excitement and fear that drive their behavior. Awareness of these cycles allows intervention before they spiral into error. Over time, the mirror effect cultivates emotional maturity. The trader stops reacting to short-term fluctuations and starts responding with composure. They no longer take losses personally because they understand that losses are not judgments, they're reflections of decisions. Every decision leaves an imprint on the chart, just as every thought leaves an imprint on the mind. Trading becomes a continuous feedback loop between the external and the internal, each influencing the other. The more the trader refines their internal clarity, the more the external market appears understandable. At a deeper level, Trading becomes a form of meditation. The constant interaction with uncertainty forces the mind to confront its attachments. The desire for control, the addiction to being right, the fear of imperfection, all of these tendencies rise to the surface when risk is involved. Trading exposes these shadows because money amplifies emotion. It turns psychological patterns that might stay hidden in daily life into visible, measurable behavior. The mirror effect doesn't create these patterns, it simply reveals them. In this way, trading becomes one of the most direct paths to self-awareness available in modern life. Through this lens, every trader's journey is an inward journey, disguised as a financial pursuit. The charts become classrooms, and every trade becomes a test of self-regulation. The more the trader grows internally, the less chaos they experience externally. This is why traders who achieve emotional balance often describe a strange calmness in their process. They still experience losses, but those losses no longer shake their identity. They still experience uncertainty, but uncertainty no longer triggers fear. The mirror effect teaches that stability isn't found in the market's behavior, but in one's own alignment with it. The most transformative part of this realization is that the market always reflects exactly what the trader needs to see. When a trader is reckless, the market provides loss to teach humility. When they are fearful, it provides missed opportunities to reveal hesitation. When they are disciplined, it rewards patience, not because the market is moral, but because consistency aligns with probability. The feedback is immediate and honest. The market doesn't flatter, it mirrors. It shows the trader the precise relationship between behavior and outcome without distortion. Once this relationship is understood, emotional detachment becomes natural. The trader no longer takes outcomes personally, they simply take notes. This perspective also redefines the meaning of success. Success is no longer measured solely by profit but by mastery of self. A trader who can remain calm through volatility, who can follow their plan regardless of outcome, who can observe emotion without acting on it, that trader has already succeeded internally, even if the balance sheet hasn't yet caught up. External results always lag behind internal development. The mind must change first. The equity curve follows later. The mirror effect shows that trading is less about accumulation and more about transformation. When a trader internalizes this truth, the market stops being a place of anxiety and becomes a space of awareness. Each session becomes an opportunity to practice presence, to stay in the moment, free from the pull of past losses or future hopes. Presence dissolves impulsivity because impulsivity lives in the future, in anticipation of what might happen next. The present moment, where observation replaces reaction, is where real trading occurs. In this state, time slows down, emotions quiet, and the mind merges with the process. This is where mastery begins to take form, not as control over the market, but as harmony within oneself. The journey through inconsistency, emotional chaos, and self-sabotage eventually brings every trader to the same destination: self-awareness. What starts as a financial pursuit ends as a psychological awakening. The trader begins by chasing strategies but ends by studying consciousness. The fast-moving numbers, the flashing candles, the rise and fall of profit and loss, all of it becomes a mirror reflecting the mind's architecture. The patterns on the chart no longer represent market behavior, they represent mental behavior. The moment this realization dawns, the trader stops asking how to predict the market and starts asking how to understand themselves. Reprogramming the mind, managing emotional state, building identity, and creating feedback loops are not isolated techniques. They are components of inner mastery. Each one addresses a different layer of the same truth, that external consistency arises from internal order. The trader who achieves internal order finds that their external results begin to mirror that stability. It's not magic, it's alignment. The subconscious stops fighting the conscious, the body stops fighting the mind, and execution becomes natural. The chaos of the market remains, but it no longer penetrates the trader's internal calm. Every trader experiences a breaking point, a moment where knowledge no longer compensates for instability. It's in this moment that transformation begins. The breaking point is not failure, it's revelation. It's the collapse of illusion, the illusion that control lies outside oneself. This collapse is necessary because it destroys the egoic identity built on outcomes. From the ruins of that illusion, a new awareness is born. The trader begins to see clearly that their role is not to dominate the market, but to master their reactions to it. The battle was never external. It was always within. The professional mindset that emerges from this understanding operates from neutrality. Neutrality is not emotionless detachment, it's emotional intelligence in action. It's the ability to feel emotion without becoming it. A neutral trader experiences both fear and excitement but remains centered between them. They move with the market, not against it. Every decision stems from observation, not reaction. This neutrality is what consistency feels like, not excitement, not relief, but quiet confidence rooted in trust of one's process. True growth in trading mirrors growth in life. The same habits that lead to inconsistency on the charts often appear in other areas. Impatience, lack of structure, avoidance of discomfort. When traders work on themselves through trading, they inevitably evolve as individuals. They become more self-aware, more disciplined, more present. This is why the lessons learned in trading extend beyond markets. The discipline to follow a plan becomes the discipline to stay grounded in daily life. The ability to manage losses becomes the ability to handle failure in any pursuit. Trading, when approached consciously, becomes a training ground for the mind's evolution. The fast fix isn't a shortcut to wealth, it's an awakening to self-regulation. The moment a trader realizes they don't need to fix the market, only their relationship with it, everything changes. The urge to chase fades, the obsession to control dissolves, and clarity emerges. Consistency stops being something to strive for, and becomes the natural state of a balanced mind. The charts no longer provoke, they communicate. The trader stops reacting to noise and begins to respond to structure. They realize that success in trading isn't about learning to predict price, it's about learning to predict themselves. In this realization lies the quiet power of mastery. It's not dramatic or glamorous. It's the silent confidence of someone who has faced their own chaos and learned to remain calm inside it. The trader who reprograms their mind doesn't just trade differently, they live differently. They approach uncertainty with patience. They handle pressure with composure, and they see opportunity not in control, but in alignment. Trading, in the end, becomes a reflection of consciousness itself, a daily meditation on awareness, responsibility, and growth. The chart becomes a mirror, the mind becomes the strategy, and mastery becomes a state of being rather than a destination to reach.